Martin, you were just saying when we were speaking earlier that you've got some brand new exciting data. Would you like to share it with the GCB audience?
Yes. So I think the stunning news, and I've been living for years in Asia and for years in the US, in California, but doing the research on the globalization of venture capital and venture capital. And I've always been sort of put down by the Americans as Europeans, saying, well, forget your performances, forget the Europe, there's no such thing as, here is Silicon Valley, it's the epicenter, and so on and so forth. And arguably, when they said, look at the performance, it sucks, right? Typically American, it sucks. I said, okay, I have nothing to hold against. There are some pretty good, cool companies coming out, but it's never at the scale and not as repetitive. And then, you know, there was the dot-com crash and the whole market crash around the world, including Europe. And so I've been continuing to do the research on investments, valuations, exits, holding time, multiples, and so on. And it's more by sort of every 2-3 years when looking at the performances in IRR or in multiples, I started realizing about 3 years ago there was some shift in coming up. And so it was a sort of a coincidence when I took the year-end data of 2015 and then started analyzing it. I go like, wow. So since 1995, I look at all the performances between US and between Europe. And the US for sure has outperformed dramatically, including the dot-com boom. The top performers, the top quartile, the median of all, they were fantastic. And we all know it, that it all crashed down. But even during that time, Europe was way subpar. They barely even made money during the dot-com boom. But it was kind of at the early stage of European venture capital. And they were, at my view, in my opinion, there were too many bankers still being VC at the time. While in the US, they already had half of them being actually operating guys, which has changed now in the meantime. A lot of VCs have phased out the financial VCs, and now the operating guys are in. So it's about, so that is one thing that has changed. But the question is, what has happened? So until 2009, that's where sort of with the financial crisis, I started sort of putting in a break at 2009 and said, let me look forward post-financial crisis. And indeed, what happens is, if I look at, what I looked at is at the top performers, the very best fund and the poorest performing fund. But then I also looked at the top quartile, the median, and the bottom quartile. And that was in the data going back is 2010, 11, 12, and 13, because the 14, 15 data is too short, right? And so when looking at this, the Americans, I'm just taking now as an example, 2013, and I'm saying, you know, the top performer is even better than in Europe. It's really stunning, but the question was, is it an outlier or not? Yeah. I did an additional analysis, which I haven't published, but I looked at the top 5 and compared it to the top, and I wanted to know, is the one a real outlier? If I take the top 5, are they close to the top one? And actually it was. So that means what? The top 5, the top 10 in US are actually really top performing by any dimension. And then I look at the European data. So as a top performer in the US in 2013, you have 116% IRR of the total fund. In Europe, you were at 83, which is good, needless to say, right? Stunning for Europe. However, when it comes to the top quartile, the median of top quartile, the US was at about 37% and Europe at 60%. Whoa, now that is a surprise for anyone, right? And you could see gradually over 3 years coming up and stretching out to that. The US increased, but Europe was just on a steeper curve. You look at the median, where the US had about 13% and Europe had about close to 33%. Now that's more than twice. Now that starts getting stunning. It's not a fraction of 1 or 2%. And then I look at the bottom quartile, and the bottom quartile was just 0.0 in the US, and it was still 7.7% in Europe. right? So that is where, and then I look at the poorest performer, and you always have a poorest performer, right? And so in the US it was minus 64%, and in Europe was minus 17. So by any dimension, you can look at any stretch except at the very best 5 or 10 funds. Now, what is the difference between the US and Europe performance ranking? First of all, there are a lot of more funds in the US. And so the number of funds in Europe are not only significantly lower, but I think what has happened is a shift. And why has the performance that dramatically improved? And so this is now, so showing you the result up front, let me rationalize a little bit on this, right? In the first place, what you cannot do is a lot of people look at the whole range of like, what's the median investment of all venture capital in early stage or in late stage? It just doesn't work that way. Simply because if you take a global median, it gives you an indication, but actually the US is about, still today, and when the data was done, it was about 60 to 70% of all venture investments. They're actually US. So whatever the US does, it shifts the needle, right? If a single country in Europe doubles or triples, it's a blip on the radar compared to the US volume. And so what I'm trying to say is, I looked at the earlier stages and I looked at later stages, but actually I broke it down by round class, series A, B, C, D, and D and plus, and then had a quick look at this. And I think the stunning results, sort of giving you a high-level summary. If I look at the series A, we can, in the first place, in corporate VC, it shows that in Series A corporate VC, it's about 20 to 40% larger per round. And I'm now limiting myself to the most relevant years, 2010 to 2015. So I just take those few years. Whatever I say now, I'm focusing on those years, although I go back to 2005 with all the data. And so it's 20 to 40% larger than the Europeans in terms of corporate venture investments. And that said, the question also is, if I compare VC with corporate VC, that's a very critical piece. Whatever I do, I have, you cannot say these are twins in a sense, right? So I'm looking at VC versus corporate VC, and as soon as a corporate VC is in the Series A in the US, it's about 2 to 1. So 2 times, if a corporate comes in, it's twice as much money in. And that's pretty consistent, actually. And in Europe, it was only about 1.25. So 25% higher median round size in the Series A. When I look at the Series B, it dropped from 20-40% higher corporate venture investment US to Europe. It dropped to between 10 and 20%. So the Europeans are sort of closer with a corporate investment. And if I look at the Series C, Series C was stunning me. It started to stun me because for the first time I see a first shift, and I go like, wow, what's going on in here? So fundamentally, we can say that the US normally is still larger, up to 1 to 2 times larger, except in 2015. And I'm curious if this is a blip by 1 year, or going forward, then if there's a real change. Because what happens is corporate investments in a Series C was suddenly twice as much as the United States. And I just couldn't get it. Now, I have to say that it could be that some of the unicorns, because the pool of the US is so much larger that if 1 or 2 or 3 unicorns get largely funded, it lifts the median, right? So high tide, all ships go up. And so in terms of Europe, looking at the total volume, which is about maybe 5 times smaller than the United States, if you suddenly have a few unicorns in, that can shift the needle dramatically. So my assumption is it's in Series C there were some unicorns, and then I looked at Series D and additional rounds, and it became even more pronounced, except that it completely shifted. It's unbelievable to me. I mean, and I have to adhere this most likely to the unicorns in this case, right? Because Europe actually, European corporate VC investment surpassed in both years the United States, and not by a small margin. It's by 20 to 50%.
Yeah.
So that said, what does that mean? It's also the ratio in those the ratio between VC, corporate VC, and VC in the U.S. was about the difference. It was pretty much balanced in the U.S. year by year. The shift was about average mean was about 25% in difference. It would vary between corporate VC and VC, so corporate a bit higher. When I look at Europe, it was much more a sort of dynamic, also because there were less deals, but there were also some significant deals. And I'm telling you, the biggest surprise to me was that the ratio would shift between 30% higher to 400% higher between VC only investment or when it included corporates. So that was pretty much stunning me. That why is it that suddenly that volume got so big? And my assumption, I haven't gotten the details of the data yet, is that there must have been a few big deals where probably not even European corporates, probably US corporates came in. They are much bigger, deeper pockets now, they're much more aggressive.
Right.
And so that was my assumption. But in the same year, what actually also stunned me is that in those 2 years, 2014, 2015, the volume of VC median round size of venture capital of European VCs was twice the one of the United States. I mean, this is just out of my mind. I still don't comprehend it. I'm looking at the data, which I haven't had a chance to really make a deep dive. But this is something that, you know, I think it was shocking anyway. It's not shocking. It's more surprising. However, so then another question would be when we look at IPOs, when we look at acquisitions. So let's look at from an exit side, and when we look at IPOs, there's a little bit of a tricky data, meaning only a proportion of the shares actually are sold in the public market.
Yes.
And it could be that this may vary from geography or industry or year by year. So it's a bit difficult as a measure to say. When I look at how much capital was raised at IPO, but still it's a typical industry standard that people report. I think in the next phase what I will do, I will go after the total valuation of the company. Not the capital raised. I just didn't have the time to do this last minute when I saw the data. I should have probably done that, but in hindsight you're always smarter. So what happens is when I look at I drill down on the US only first and look at 2010 to 2015, what it means when corporate VCs are involved and corporate VCs are not involved in the US. So when you look at IPOs, and the difference in the IPO size is about 10 to 20%, which is understandable, makes sense. There's no issue to me on this. When I look at Europe, it was totally stunning, and it was very consistent in the US, 10-20% over those 5 years. I look at Europe, and the difference would be dramatic between when corporate VCs were involved versus VC only. It was ranging in year between 40% and 300%. Wow. So, however, we also need to keep in mind that there were actually, compared to the US, there are very few European VCOs in Europe, compared. Right? So, again, you have a few big hitters, it can dramatically move the needle.
Right.
So that is a little bit different when I look at than the M&A. But in a nutshell, I can say if I look at US versus Europe and I look at the actual IPO size, when corporate VCs are involved in those at least 4 of the 5 years, it was the ratio of an average of 3 to 1. So it was much higher. It was higher in the US than in Europe, about by a factor of 3. Except in 2015, that was the 1 year that actually the average median was 80 million raised at IPO, where Europe matched exactly the United States. So that's another sort of indication that something's shifting, needs to be analyzed. However, if it's a VC only, this is another interesting thought that I think most people are actually not aware of. So I said typically it's about 3-1 in US versus Europe. If it's only VC, in IPO, and again I'm repeating, there are much less IPOs in Europe, it's a factor of 4-1. So the US beats up Europe in terms of size. But this is exactly what I want to educate the world a bit. Because everybody said, so what? It's so much smaller, so what? But look at it, it's very simple. If I put in 3 to 4 times less money, I can exit 3 to 4 times smaller. I get the same IRR or exit multiple.
Yes.
And as an investor personally,
I
don't care. I don't care whether the difference is, and I think this is where Americans are much better marketeers and communicators, and good at showing off in a sense. I mean, let's be frank. I mean, I've spent 11 years between Berkeley and Stanford. So the key is that an IPO exit typically in Europe, because it's being 3-4 times smaller, is not making headlines on Financial Times or Wall Street Journal. Now, if you have a cool company coming out with 500 million, and in Europe it's 100 million, so what? Right? The 500 million will make. The same thing with an investment. Wow, they got a $500 million round, a magic leap, and the European equivalent will probably get 100 million. But again, it's all about, so it depends from where you look at, right? And so from an investor's point of view, personally, I'm a personal investor, an angel investor. And to me, I don't care how big it is. I'm looking at my return at the end of the day. So that's a little bit different to corporate investors, and which have a strategic angle plus mostly also financial angle. And they may look at this. So I had a huge dogfight about a year and a half ago in the United States in one of the corporate venture conferences, where I was telling them hard and said, you are not understanding what happens, for instance, the unicorns. The unicorns are going to drive down the overall performance of the industry. And because it's so much money, it has a massive impact on the industry. And no, everybody was looking at me weird, because it was like the heydays of unicorn investing.
Yes.
Right? And so a year later, I showed it already came down by half. And now it's dramatically down, and you will see the tourists, the hedge funds and and also particularly the mutual funds, sort of being a lot more careful, or even leaving maybe the industry. But they shouldn't have been in my view, personal view, in the first place. But that's my personal view. So let's look at. So we had IPOs where the U.S. was much bigger, just by the sheer fact that the public markets are much larger, and additionally, of course, simply because there goes much less money into European companies. But the multiple, as I will show later, is interesting. You will see. So in terms of M&A, so this is much more. So Europe and the US have a fairly significant number of companies, like 90% of all the exits are plus minus historically the last 10, 15 years are actually M&A. And when I look at this, I can say that if I compare in the US acquisitions, it varies year by year in 2010 to 2015 between about 50 to 300%. It's a fairly large range year by year, corporate VCs versus VC, right? So when I look at Europe, it's almost identical. That's very interesting. However, the number of acquisitions in Europe is also significantly large, right? And so what's interesting is that if I look at the investments going in, because I did note the investments, a VC investment only in the US of a company which gets acquired ranges between 30 and 50 million. In Europe, it's 20 to 25. So it's about half of it, pretty much, right? If I look when corporate VCs are in, when I look at when corporate VCs are in, let me see, the US ranges 60 to 100 million. It's exactly twice as much as if it's a pure VCN. So it's a lot of more money going in. While in the Europe it's 40 to 60 million. Again, it's about half of the United States. And so when we look at this, so we say about companies that exit through an acquisition receive about a median about half the investment. So we'll keep that in mind for later on, right? So then for 10, 15 years, I'm trying to teach and preach the European VCs, and that's another piece which is critical and difficult. In my personal view, is even if the entrepreneurs say in the US, oh, there's not enough money around, it's not true. I mean, I'm looking at it on a global scale. The US is almost, I call it flooded with money. If any of the geographies is underfunded, in my personal view, it's actually Europe. But when you are underfunded, that means what? When you're underfunded, then a VC is much more critical by selecting an investment. Because, first of all, the funds are much smaller.
Yeah.
Right? And so, giving you an example, I did a research on all the Swiss top performers, because Switzerland is a small country. Yeah. There's very little venture capital there. And it became very obvious as soon as they reach a Series B or go to the market, they have to get international VCs in. And when I did that research at that time, it was very stunning that I looked at the very largest, best deals of Switzerland. And it's a good example for the rest of Europe because a lot of geographies are small in venture venture funding. The largest investor that came into Series B, C, D actually were Americans. And when you look at the funding, it was almost the size of an American company, which is stunning because the US is used to investing much larger dollars. However, when I go to Germany or France or UK, there's quite a significant amount of money available. Maybe still not enough, but let's say there is a lot more than in tiny Switzerland. And so they can actually bring out their companies up to the exit with a pure domestic funding or an intra-European, like the French will chip in or the German VC will chip in, along with the UK VC, right? For a British company, for instance. And so I'm coming back to the point. So I used to argue for 10, 15 years already. And at that time, I think I was a bit too early. And I tried to educate European VCs because at that time, there were only 2 or 3 VCs from Europe who had an office in the United States. Yeah. And I kind of accused them saying, I said, you don't even have a strong network and relationship in the United States. Even if you don't have an office, but you have at least to have the network. Why? Because if you have a company that invests, that is being invested with much less money, and you get not only the customer and the market in the US, but you get an acquirer at the end, they don't care how much money went in because they look at this company and they say they know in the US that's an average or median is about that much worth.
Right.
Where it came from and how much it was funding, maybe there's a mini discount on it. So I don't care. So now you start seeing what I'm trying to say. I always said you focus, if a company has a global, particularly technology companies, focus on the US market early. Try not to get US VC in early because they will just plow in the same amount of money. And if you can get European money and then go to the market and exit in the United States, guess what happens, right? You double, triple. You're basically, depending on how much money went in, your exit multiple. So that's so I started looking at, it's interesting, just the last 3-4 years, I'm looking at the data, and the data says it's typically, so between 2010 and 2015, it's in the range of 20 to 30% of all companies now that get acquired are acquired by a US corporate, which is good. I love it, right? So my dream kind of almost naturally came true. And so that is the average in the last 5, 6, 7 years was about 25%. So looking at another thing to look at, I'm trying to make this a bit quicker, is how long is the holding time of a company? Do we know, especially if it's an IPO or it's an M&A? I always knew, because I've done this for 15 years, there's a significant difference. But how big is the difference in US and how big is the difference in Europe? And we all know, if you go by IRR, your return on your investment, then time is a factor.
Yeah,
right?
Sure.
So here is how it goes. If I look at the last 4 or 5 years, 2011 or to 2015, if it's a corporate VC involved, it takes about, across all sectors, it takes 8 years from a first institutional VC funding to an exit. At least one corporate investor in, 8 years. If it's a pure VC, it's 6 years. So to me, that's never a surprise. I knew this for years. You know, corporates are much less driven to an exit. They are in love with technology, and they want to get more and more and squeeze out the technology and extend. And that's where sometimes the trade-off or the battle is between a corporate VC and having a VCN, right? And so here is, so it's 8 years to 6 years. It's a 2 years difference. So it's 8 years to 6 years. In Europe, if I look at, and that's a company that IPO'd. If I look at Europe, it's 6.5 years to 4.5 years. So it's also 2 years different. On the higher end, when a corporate design is slightly lower, without a corporate, it takes slightly a bit more. So it's still the 2 years difference. It's kind of almost equivalent in my view. So, however, when we look at acquisitions, from a first investment, if a corporate VC is in the US, it takes 6 years. If it's a VC only, it's 3.7 years. So kind of 6 to 4 years. In Europe, it's 5.5 years versus 6 years in US. It's kind of equivalent. Yeah. And it's 4.5 years. So let me say, when it comes to acquisitions, it's a kind of similar time to exit. Okay. I'm perfectly okay with it. Nothing wrong. However, when I come to the exit now, let's look at performance. Performance is measured in this case now in multiples. I gave you up front the information on IRRs, which we know. But now it's also interesting to see what it means corporate included versus VC only. So if I look at IPO first, and I have the US, then between 2010 and 2015, the multiple with a corporate VC is about 3x. In Europe, it's also 3x. So no difference. Yeah. However, there is a significant difference between, and that's on IPO, VC only. In the US, it's 6x. And in Europe, it's only 4x. However, so then the question comes back, why is Europe still strong performing? In a sense, right? Because keep in mind, there's a small fraction of the deals actually exiting through IPO. Right? That's the point I'm making. Because you will see in a second that the breakthrough of Europe comes through M&As, through acquisitions. And so if I look at the data in acquisitions on multiples, on the capital multiples of capital invested within an acquisition, then we can see that when corporates are involved, in the US it's a 3x. In Europe it's a 5x. Wow. And when VCs only are involved, it's a 4.5x versus a 6x in Europe. So since 90+% of all the deals exit through acquisitions. Yeah. And Europe is that much stronger in the last 3-4 years. Wow. Now you can see, and there are several reasons probably why, you know, as again I'm saying, in earlier research I've done is I could see European, given the limited amount of capital European VCs have, they push a bit harder for early revenues than the Americans do. They're a bit more capital efficient. I don't allude this only to capital efficiency, because again, a third of the deals last year, or 25% in the last 5 years, exited in the United States. Right. And if you get at least twice the amount, sometimes even more, for a company, for the same company if you exit in the United States. So that goes straight to bottom line. Right? So if I sum this up, is Europe in IRR is outperforming. In the last, as I said, 2010 onwards to 2013 is clearly outperforming. Given the latest increased spikes, which I saw in 2014 and 15 in Europe, investing on corporate VC and VC of the median rounds investment, I'm not quite sure this is going to hold. It's like the US phenomenon kicking in. It may come down. I'm not able to predict this at this point. I haven't had a chance to look at this, but my crystal ball will tell me there's a chance it may come down again. Nevertheless, all I'm saying to summarize is Americans, corporates, VCs, and LPs have pretty much, because also a kind of almost ignoring Europe, created a situation where they were much more cautious with their investment and more capital efficient, which drives up the performance. And you will be very stunned to see that I guarantee you one thing. Just recently, the lot of Chinese, the Baidu, Alibaba, Tencent, particularly Alibaba and Tencent, have significantly invested in the United States. And they are only showing now at Europe. And if they find the prices with the same quality of technology, I guarantee you they're going to be huge in Europe. Yeah. And I can assure you, you wait the next 5-6 days, and you may see the first deal of one of those 3 companies out of China. I'm not going to disclose it, in the range on a single deal. And it's not an acquisition, it's a majority stake. That's part of a strategy. They go in early stage, but they also take up massive stakes. It will be about a $5 billion deal. Huge. So what does that mean? If I look at total VC investment in Europe the last 2 years, ranging anywhere from, I say, 10 to 15 million, $1 billion, right? And then suddenly a single deal comes in with 5 billion, that shifts the game. Absolutely. And this could cause other Asians also to look at it. Today we have been almost, the Chinese have been almost absent. The Asians have been almost absent in Europe in venture capital investments, almost. This exception maybe a bit of SoftBank in the older, they're a bit different, they're also much older. But I assure you, same as with real estate, you will see the Chinese and the Asians looking at very attractive environment here. So that's all I can say. I'm very happy to see that I don't need to go back to the US and excuse while Europe is not performing. It's a lot of fun for me going back and bash back a little bit, right? And saying, you were dead wrong. You totally underestimated, you ignored it. Keep on looking at it. And so I'm very positive on that. And I think that also means what? If this data gets public, increasingly public, and there will be more publications on this, international, I mean even European LPs who more invested in venture in the US than actually did in Europe, they may shift back actually here to Europe. So I see a lot more venture funding coming up. Let's keep fingers crossed that they can keep the capital efficiency and leverage the US European, and maybe you will see a lot of Chinese and Asians kicking in, maybe as huge acquirers, which can drive up dramatically also the returns. That's it.
So Martin, if this is the case, so first of all, we're not clear yet how sustainable this trend is, because it may be that it's a certain number of unicorns in Europe driving up their returns, possibly. We're not sure exactly what the...
No, not the returns. As of now, the returns have not been driven by unicorns. The investments have been driven by unicorns, but not the exits.
I see.
So I'm actually more worried that there have been too many unicorns funded. This is my personal conviction. So that may drive down in US, in Europe, or even in Asia, probably, the returns, which have been quite cool in the last 3-4 years. So I'm a little bit worried that it will drive down but so I think that's clear. It's not being driven today by the exits of unicorns.
Okay, gotcha. So in terms of how attractive Europe is starting to look because of the outperformance, what do you think are some of the things that, say, governments should be thinking about, or other players in this ecosystem should be thinking about in terms of making Europe as attractive as possible?
Okay, I think there has been a lot of focus, and I'll tell you where the caveat is in Europe. There's been a lot of focus on very early stage funding, Series A, Angel. They've done a good job on this already, significantly good, I have to say. I look around Europe, I look 10 years back, it's been a disaster more or less that time. I'm okay, more or less today. Still, you know, you can tweak here, there, improve somewhere. I think the challenge we have in Europe is not the Series A, it's the Series C, D, where a lot of more capital is required, which we don't have in Europe. Very few funds have it in Europe. And that's where the US kicks in big time. They even have growth funds in that sense, which we barely have in Europe. And I think the only thing that may help, in a sense, is when the funds of funds and the LPs, they have learned over the last few years to co-invest, right? And so my hope is that, and I'm telling you for what reason. The easiest is you approach a US VC, you'll get the bigger funding. Very likely, particularly if it looks like an attractive company. But then I call it's an American cookie cutter, meaning they're going to be as good or as bad as an American company in terms of returns.
Right.
So my hope is that if the funding can be done in Europe with the same rigor,
I see.
right, and the LPs from Europe chipping in as co-investors with the same rigor and not with, you know, I call it the American glasses on, right? Then I think it will still outperform the United States.